Okay, so we'd like to thank everyone for joining today and our Trust Ed webinar on navigating the complexities of closely held entities in fiduciary accounts. My name is Josh Obregon. I am the Valuation Manager here at ITM, and presenting with me is Patrick Allward, the CEO of Trustworthy Consultants. A couple quick announcements and reminders. We ask that you please complete our short post-event survey after this webinar has concluded. And within 24 hours, you will receive an email link with the recorded event, as well as a certificate of completion and the ability to request the materials for your CE credits. Then, of course, the views shared by the panel do not reflect the views of any other person, company, or organization. The next, Patrick will talk about our agenda for today and go over what we will be discussing.
Well, thanks, Josh, and good afternoon, everyone. It's great to be here with you all and great to be partnering with my friends at ITM. My name's Patrick Elward. I'm a consultant, as Josh mentioned, but also spent a considerable amount of time on the trust side, 34 years in total. Spent 15 as a chief fiduciary officer at National City PNC, and then worked with our friends at ITM when I was at RIC as well. So it's great to be here. Today we're going to be focused on closely held businesses. So we're going to take a deeper dive in this particular asset class. We know there's a lot of information to cover, so bear with us and we'll certainly get around to your questions, but some of the things we're going to cover are going to be from a high level perspective. So this is the kind of the roadmap. We'll start a little bit about why they're in trusts, some basic characteristics of them. We'll talk about some of the challenges and some of the regulatory requirements that are imposed on you as trustee. And then what we'll do is Josh will take it from there as a valuation expert and talk a little bit about some of the methodologies deployed, and we'll certainly have time for your question. Closely held businesses. So if you could advance a slide, please. You know, I like to start with this slide. The IRS periodically publicizes statistics for the filings of Form 706, the estate tax form. And there's some interesting information there, and I've shared the link and the website, so you certainly can take a look at that if you want. There's all kinds of stats they have. They go over what states have the most filings. It's usually California, by the way. But one interesting composite that they have is what type of asset portfolio is in these filed 706s. And interestingly enough, unique assets are always a part of it. As you can see with small businesses, regardless of what size of state, it's always around 5 or 10%. And, you know, if you combine that with real estate, another unique asset, you get into the 20 to 30% range. So although these are just IRS Form 706 filings, it's also reflective of what high net worth individuals are investing in. So as all of you are trustees out there or fiduciaries, you know, it's certainly something that you have to continue to pay attention to and make sure that you're aligned with experts along the way. If you could change the slide, please. So why would you hold a closely held business in a trust? I mean, certainly certain particular closely held businesses offer protection from creditors and liabilities, but having that extra barrier in trust has some benefits that many of you may know about. Just to call on a few of these from a business succession perspective, you know, a trust can help with a smooth transition, especially if you have a lot of beneficiaries and you might have a contentious situation, right? A lot of these beneficiaries oftentimes can get emotional, and a trustee is unbiased, certainly doesn't get wrapped up in that emotional aspects, so they can ensure a smooth transition. In conjunction with that, same thing with business continuity. You know, you want to make sure there's less disruptions when you're transitioning a business, so it doesn't impact sales and profitability. So those are some benefits of having that in a trust, because a trustee should be armed with not only the resources they need, but understanding the process during the estate settlement administration period. Having a closely held business in a trust can offer some asset protection. And again, some of the entities itself offer asset protection, but having that additional trust can help shield creditors, lawsuits. You know, when I was in the trust department, we used to see some divorces, and oftentimes all the assets are under purview and under consideration, but having a closely held in a trust would be an additional barrier. So a benefit just from that perspective. Estate planning is kind of common sense. I mean, certainly there's some estate tax benefits to holding a closely held business in a trust. In addition, the probate process, which offers privacy, as you can see there, is an additional benefit when people don't really want their information to be public, especially with a family-owned business. And then last but not least, unbiased oversight. As many of you know, as trustees, you want to avoid conflicts. A lot of times families can be emotional, and you as a corporate trustee offer that confidence that you're not going to be biased, not going to be prejudiced, and you'll adhere to the document in accordance with the fiduciary laws and practices. So those are a few reasons why you might hold a closely held business in a trust. So I wanted to give you a perspective of certain types of entities. Now, we could spend probably the whole hour on different types of closely held entities that we periodically see in trust, but want to just do a high level perspective. So the first is the simplest form, a sole proprietorship. This is a simple structure, minimum paperwork. The owners are personally liable, obviously, for debts and liabilities. Taxation is all to the owner. So you might see some of those in the trust. An S Corp. So an S Corp is a little more of a complicated structure. You have a separate tax-paying entity, and you also need to have an election to be an S Corp. I want to say it's Form 2553, if I'm not mistaken. So it's a pass-through type entity where taxation is passed through, and generally the shareholders, mostly individuals, but it can be a trust, would also need to adhere to rules. So what are the rule examples? So for example, you have to have under 100 shareholders, which a C Corp would not. So an S Corp is certainly a little more of a complicated structure, but nonetheless, it's a pass-through entity. Switching to a C Corp. A C Corp is a more complicated structure. Why? Well, it's governed by a board of directors. There's a lot more paperwork. It's a separate tax-paying entity, so it's certainly not a pass-through like an S Corp. The other unique thing about a C Corp is it can have double taxation. So what does that mean? Well, the C Corp as an entity might pay tax, but then as they distribute dividends, the shareholders have to report that on their Form 1040. So there's kind of a double taxation that, you need to take into consideration. The assets are usually protected, individual assets from liabilities and creditors. And there's an unlimited number of shareholders. So that's why some of the companies are more structured that have a lot more employees. The other thing about a C Corp is a lot of times you want an entity like this when you're raising capital. So, if you have an initial public offering, an IPO, or any type of capital, oftentimes you'll see that in a C Corp where it's a lot more structured. If you could switch the slide, please. A couple more types of entities we often see in trust. A partnership, probably one of the most common entities we see in a trust. Now, you have different types of partnerships. You can have a general partnership where someone's operating the business or very involved from a management perspective, but you can also have a limited partnership, which someone's probably more of a passive investor. And a lot of times you'll see that in a trust where you have a minority shareholder. And you can also have something called a limited liability partnership. But these are not incorporated. You have a partnership agreement that probably binds the ownership structure of that, and also talks about the responsibilities for both income, expenses, duties, that type of thing. It's typically a pass-through entity for tax, and the partners generally make the decisions, but you're going to see this pretty commonly in a trust, especially a limited partnership. And again, you would have a much higher risk from a general partnership perspective if you had responsibilities for managing the company, making decisions, hiring, firing. So as you're entertaining a pre-acceptance process, you always want to make sure you understand what type of entity you have. Last but not least, you have a limited liability company, an LLC. This is a very popular structure. Owners are often commonly referred to as members, You do have a Secretary of State filing with this, so there are some corporate similarities from a kind of a reporting perspective. But from a taxation perspective, you have a lot of flexibility. You could tax it as a partnership, you could elect it as a corporation or a sole proprietorship. So you do have a variety of ways that this can be taxed. One of the most critical things for an LLC is the operating agreement or anything like that, whether it's bylaws or operating agreement, because that type of document, as we'll learn along the way today, will kind of dictate certain things. It'll dictate control, liability, withdrawal and voting rights. So it's a critical document, especially as a trustee if these are held in trust. So these are just a few common entities that are held in trust, and at the bottom of the screen I've listed a few more. Family limited partnerships, a lot of times those are investment holding companies where families will have a kind of a general partner and a limited partner. We've seen those in trusts. We're seeing a lot more private equity situations held in trusts and other type of holding companies as well. So again, this is not an all-inclusive list, but in the same respect, this just gives you a flavor for what we typically see from a closely held perspective held in the trust. All right, so the next slide, I just put common characteristics, and I wanted to place this here because in addition to the entities, oftentimes you're going to see some characteristics more times than not held in the trust. I did want to point out that if you're accepting an operating business in a trust and you have sole discretion, so you have sole authority, you're kind of on hook to make sure that organization is operating appropriately. So you have to be very careful what type of entity that you're accepting in trust and managing, but more importantly, making sure that you have adequate resources to help you manage that asset. Because if it was a manufacturing company, would you understand the financials? Would you understand the sales pipeline? So they can be pretty complicated. And I do know some organizations shy away from operating companies, but they are prevalent in trusts. So it is something that you might want to consider, especially if you have the right process in place and the expertise. Investment company and rentals are certainly prevalent. You'll see those a lot in trusts, especially rentals. And as I put in the next bullet point, oftentimes you're going to see an entity, whether it's an LLC, but might have real estate as one of those assets. As Josh will tell you later, and Josh does a lot of valuations for many of you, oftentimes Josh is not only looking at the entity, but he has to take the real estate into consideration because that's an asset of the company. So that's a very common situation we often see in trusts, and you have to make sure that you're not only mitigating that, but evaluating it properly too. The trust company should specify your duties. Now, a lot of times it can be vague, right? I don't know about you, but I've read a lot of different trust agreements. If it's clear, it's no problem. Like if you have sole authority for all the assets, that's pretty clear, and you have to make sure you understand your fiduciary duty. But sometimes you might be directed to hold an asset, such as a closely held business. And when that happens, you have to make sure that that language is clear. I've seen language that says, hey, we've had this vacation home in our family for 200 years, and it's been passed on to every generation. And we really, 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 really hope that you keep this property, but you have the authority, so it's your decision. So you have to watch the language and make sure that it's not confusing. Sometimes the trustee is directed, but oftentimes it's not. So we just talked about that. And then the agreements are very important, as we'll learn today, whether it's a partnership agreement, operating agreement, trust agreement, shareholders agreement, bylaws. These documents are critical to help you understand, which we'll learn a little bit later today. And last but not least, trustees often utilize third parties like our friends at ITM and others to help analyze the values. But if not, you have to be comfortable with these values. Now, remember, I know many of you charge a fee based on the fair market value or assets under management, or a flat fee for unique assets such as closely held. If you're charging a fair market value fee on a closely held business, you better be sure your valuation process is pretty solid, or you could have some liability. Next slide, please. So I wanted to talk a little bit about business succession considerations. I get a lot of questions on this. You as trustee have a lot on your plate. And oftentimes, if you had a business entity, especially if something was an operating company, balancing the dynamics between management and ownership can be tricky. Why? Because the family and the management may not be the same. It may be the same, but the family may not understand the management transition plan, and the management team may not understand the estate plan. So oftentimes when you're coming in and there's an estate situation, you're dealing with both stakeholders, and understanding that there's a transition of both management and ownership is equally important. Next situation, what if you have a primary owner that dies unexpectedly? And that's happened to us when I was trustee, and I'll give you a case study here in a few slides. What if that person did everything? Well, you have to jump in there immediately and figure it out, and that can be pretty complicated. So you have to substitute that person. How are decisions made? How does that transition work? So you have to plan for these kind of situations because it will happen. The other question I get is, Patrick, what dictates, what has the highest priority, a trust agreement or an operating or partnership agreement? Well, it depends. You have to make sure you understand both documents. Now, it will depend, because a trust agreement will certainly talk about how the assets are going to be distributed upon a death or a transition and fit into an overall estate plan. But you also have an operating agreement, possibly, that's a binding contract. So you have to adhere to that. And there may be conflicts with the approval process with the operating agreement if you have an LLC with the members on how something's going to be decided or approved upon. So you have to take both into consideration. So there's not a right or wrong answer, but you have to understand both documents and make sure that you're adhering to it. And you may need consent on decisions too. So understanding that dynamic is something that's very important for certain type of entities. Financial and tax considerations, we're going to talk about valuation in a bit with Josh, but even distributions about, do you distribute something in kind? I had a client that had an S Corp with some Airbnbs in North Carolina, and we had to make a decision whether we were going to help the S Corp throughout the way or distribute them outright in kind. And that's what we chose to do. There was less liability there, and we wouldn't have to sell the property, or the trustee wouldn't. So a lot of times you have to look at these distribution options and figure out what's best for the client, but also figure out what's less risk for you as a corporate trustee. When you do distribute an asset, whether it's in kind or sale, what's the price? Now, again, it would depend on some of the documents that we talked about earlier, but you also may have a buy-sell agreement in place. So a buy-sell agreement, is an established pricing method to help kind of avoid disputes. There's really, if you have a buy-sell agreement that says this is how we're going to determine the price, that's how it will be determined. So the good news is someone can't say it's too high or too low, because that's already been decisioned, again, in a binding contract. But it also helps for a smoother type of transition. There's less risk there. There's going to be less process if it's on a determined price. But you also have to make sure it's a fair price. Otherwise, some of the stakeholders may challenge that. But again, you'd have to look at the validity of the documents. Anyway, I wanted to mention a few of these succession considerations because I do think they're important. And as a trustee, if you're owning some of these businesses as an asset in the trust, you're going to have to deal with them. So let's get into some regulatory requirements. And I'm going to focus a little more on the OCC handbook just because they deal more with unique assets. And I won't go through these other ones, but as a trustee, you have a lot of regulatory requirements. And regardless of if your jurisdiction is a national charter like the OCC, Federal Reserve, FDIC, or states, you certainly have to adhere to a lot of the regulatory rules. And depending on your state, you may be a uniform trust code state, you may not be, but you're going to have some duties and duties of impartiality, duties of loyalty, and those type of things. And with a closely held business, you're going to have to make sure you take that into consideration. As far as the OCC, which is kind of the guidelines, but again, and we'll jump into some of these in a little more detail. I'm going to walk you through the pre-acceptance process in a little bit, and a little bit on the Reg 9, but we're going to talk about the OCC on the next handbook. But you also have other laws you have to think about. So for instance, if you accept a closely held business in an IRA, you have ERISA and or IRS code rules. I'm sure in 2015, you remember when the IRS changed Form 5498 to include lines 15A and B, fair market value of unique assets. That kind of changed things. I know a few banking organizations when that came out that said, you know what? We don't want any more closely held businesses in IRAs because we don't want to be on the hook for the value. So again, you can still hold them and you can adhere to those type of rules. You just have to make sure you're evaluating those assets accordingly and reporting them on a 5498. Adherence to governing documents. I mean, certainly that's rule one, but again, you could have ambiguous type documents or confusing documents. I will say I see a lot of non-judicial settlement agreements used, and that's a great tool. And I've seen them with closely held businesses. There's a National Trust Closely Held Business Association that I go to every year. And we had someone speak on NGSAs last year in Pittsburgh. And they did a great job outlining how, depending on your state law, non-judicial settlement agreements can help you direct that asset so you're not liable from an investment perspective. So that's a great tool to think about. And last but not least, there's various state laws. You know, I put environmental in there because if it holds real estate, you could have an environmental situation, but you also have AML, BSA issues to think about. Does everybody remember the Corporate Transparency Act? You probably do, but the good news is, although that sunsetted, you still have to identify and verify business ownership. Next slide. Now we're going to go on the risks and challenges of some of these. So this is the OCC handbook and kind of the Bible. It came out in 2012, published in 2013, and it talks a little bit about some of the risks and some of the guidelines. And for today, just want to introduce you to this tool. I'm sure many of you know about it, but it really is good to read in respect to understanding the risks and some of the tools that we're going to go over, such as pre-acceptance process. From an operational perspective, you know, there's some risks there, not only to earnings, but transactional processing. You know, if you get a check in, making sure that's income and principal appropriately. Compliance risks, we've already talked about, making sure you're adhering to the laws. And strategic and reputational risk. You know, in other words, if you're going to accept a closely held business in a trust, are you properly aligned with the vendors to accept that, or do you have internal resources? I will note reputation risk in March of this year was kind of stricken by the OCC because they just feel that some of the other areas of risk are a higher priority, and hopefully you avoid a reputational risk if you're doing a good job on the others. So I did want to make note of that. So these are just some trustee oversights, and we're going to dive deep into valuations. We're going to dive deep into Reg 9, not as deep, but pre-acceptance is one of the most important tools I want to spend the most time on. But you have other things you have to worry about. Estate settlement we talked about, vendor management, fiduciary capacities, governance from a committee perspective. We won't talk about too much today, but you could have a unique asset committee, depending on how many unique assets you have, especially with closely held, and tax reporting. Next slide, please. So these are some of the challenges that are specific in addition to the regulatory requirements you have. The first thing is when you accept an account for closely held, you have to make sure you have the expertise. I think we've said that a few times. Second, as Josh will cover, is valuation. We'll cover pre-acceptance governance with your committee structure, as I mentioned, making sure there's proper escalations there. From an investment perspective, you have to make sure the property meets the needs in accordance to the governing document. Now, if you're relieved of your investment responsibility, it may not have to be productive. But what if you have an income beneficiary and you do have sole authority? You know, should you do something about it? What if that asset, that closely held business, is 40% of the trust? Do you have a concentrated position that you have to worry about? So there's additional challenges that you have to think about in addition to the others that we talked about. Insurance coverage for a closely held business is something that needs to be considered and often talked about. And we talked about the tax reporting as well. Next slide, please. So here's a quick story. So when I was at PNC, National City Bank, we had, if anyone knows my friend Bruce Hendricks, who helps run their closely held business, he and I had a situation where we had an asphalt company in Virginia, and the owner died. And the owner was head of sales, head of operations, CFO, accounting, and relationship manager. So luckily, we were aligned with the management firm that could come in and help run the manufacturing company that had experience with that. So we immediately hired them, and they went in. Well, they reported back in about a month and a half and said they've looked through some of the accounting reports, and they couldn't find some monies. Some monies were missing. Well, come to find out, the daughter who worked for the company was stealing the money. So what did we have to do as executor? Now, again, this is an estate situation, and you're on the clock, right? So not only was that closely held business an asset of the estate, but you got to make sure you're monitoring and maintaining that. And if there's any severe disruption, we could be at risk with the beneficiaries. So we fired her. We went down and fired her. And after we fired her, we found a shotgun and a bottle of Jack Daniels under the desk that she was sitting on after we fired her. So it was a unique situation, and we're kind of glad she didn't kind of reach under the desk, even though we didn't know what's in there. But the moral of the story is making sure you're prepared for these type of situations. Like, we were aligned with that management consulting firm. So if you do accept these type of closely held businesses in the States, you have to make sure you're ready to act. It's a little bit funny to laugh about it now, but Bruce Hendricks and I weren't laughing when this happened many years ago. Anyway. So these are some controls and monitoring tools, and I'm not going to go through them, but I hope you can appreciate that there's a lot of things you can do as a trustee to mitigate the risks for closely held businesses and other unique assets held in trust. They're not in any particular order, but from an oversight perspective, making sure that your committees, your policy and procedures are structured right with appropriate escalations for management. So if you have an operating company, making sure that if someone's sitting on a board, that gets approved properly and maybe reviewed on a periodic basis and also properly documented. In the middle with assessment, one thing I highly recommend all of you consider is risk rating your assets. If you have a company that's 50% of the account, majority ownership, or it's 70%, that's a higher risk than a 4% limited partnership. If you have an operating company, that's a higher risk. So you might want to consider risk rating your unique assets as well as closely held businesses, but all your unique assets. Last but not least, controls. We're going to dig into pre-acceptance here. So we'll get into that, but there's a lot of tools that are out there, pre-acceptance, post-acceptance, Reg 9s, and a lot of systems that you use that are designed to help you mitigate these risks. Next slide, please. So pre-acceptance process, let's start with this. Regardless of your regulator, you're going to have some type of pre-acceptance process. Now, as a consultant, I review these all the time. Oftentimes, I'm employed to help enhance or strengthen pre-acceptance process. So it's screening the account before you have any surprises, right? The account type and capacity matters. If you're directed to hold an asset, you're going to have less risk, less liability. But you have to also get enough information to make an informed decision. And that can be a problem. And believe me, I chaired our acceptance committee. I fully understand that. But in the same respect, you're kind of on the hook if you're going to take on that expertise. So getting as much information as you can get, and on the next slide, I'll show you what you can kind of need, is very important. Now, one thing that's underlined is successor trustee. Why is it underlined? It's underlined because you want to pay special attention to any account coming to your organization from the organization across the street. Make sure there's nothing going on. If you're going to get more information than less, make sure you always do that for a successor trustee. So let's get into a few specifics about what type of documents you might need for a closely held business. Next slide, please. So these are kind of some specific ones. Now, again, for a pre-acceptance, you're doing a lot of things. You're reviewing the trust agreement. For closely held businesses, you have to make sure you understand the ownership structure. Now, why do I say that? Do you know how many times I spent looking at several documents, and all of a sudden I get a partnership K1 that says, you know what? This limited partnership is owned by the individual, not the trust. So you have to make sure, whether you're looking at tax returns, whether you're looking at acceptance letters, shareholder agreements, you gotta validate that ownership. Websites can kind of do that sometimes, Secretary of State type things, but the ownership could be an assignment. Make sure you're getting that information. Ownership is very important. You also want to know the percentage. You know, if a closely held business is 5% of an account or 50% of an account, makes a big difference from a risk perspective. Second thing is value. You need an approximate value. Now, I'm not suggesting getting a valuation for a closely held business every time you accept it. It's not prudent, it's not reasonable, but you have to have some type of value. You know, did they do a value 2 years ago? If there's a piece of real estate, wasn't there an appraisal done 3 years ago? If there's a piece of real estate, can you go on the tax assessor's website, get some type of derived value, at least for pre-acceptance. And then post-acceptance, you can certainly validate that. We've already talked about retention language, just making sure you understand your responsibility, making sure you have enough documentation to support that. Management responsibilities, control. You know, if you have a majority situation, are you a decision maker? Can you vote? Can you hire and fire people? What about vendors? What about additional shareholders? Make sure you understand your span of control for what your ownership is. Same thing with liability. You know, a lot of times there's a language to exonerate or hold harmless a trustee. Just make sure you're comfortable with that. Can you get out of a withdrawal situation easily, or is it difficult? Making sure you understand that process. We talked earlier about the trust agreement as well as an operating agreement. Understand how, if someone dies, you're going to be able to get out with your trustee shares. Investment risk, concentrated positions we've talked about. Is it productive? And last but not least, conflicts. You want to make sure you're avoiding this. So the pre-acceptance is the key, in my opinion, to helping you understand how to avoid a situation or any surprises. Next slide, please. So this is kind of a summary of the information needed. And again, it's a high-level summary. Make sure you get all the documents in respect to not only the trust, but also the type of entity. Second, make sure you get any supporting agreements on that entity, any shareholder agreements, bylaws, things like that that help with restrictions, with rules, tax returns, financial statements. If they're audited, great. If they're not audited, still get them. And last but not least, dig deeper for successor trustee situations. So one thing to think about is a checklist. Now, I'm not advocating all these different type of checklists. If you don't have a ton of unique assets, maybe have a unique asset checklist, and closely held is part of that. But you know, if you're getting a lot of closely held businesses and you have a lot of real estate coming in, maybe have a separate checklist. The checklist will help make sure you have a consistent process to gathering and evaluating that information. So that's just a tip I thought I'd share. Next slide, please. So the last thing I want to talk about is ongoing. Now, this is only one slide for a Reg 9, but let me tell you, your ongoing job as a trustee can be complicated. So you want to make sure during a Reg 9 that you're assessing the situation. Has anything changed? Well, what can change? The value can change. If you had income coming in, did it decline by 20%? Did you have any trigger events? If you had an operating company, did the CEO recently leave? So you have to evaluate it. What's tough about a Reg 9 is you have to look at the closely held in conjunction with the rest of the investments. You have to look at it in its entirety. So that can be tricky with a larger organization because sometimes a portfolio manager may not be an expert in closely held business. So you have to make sure there's a concerted effort there. You want to make sure you get appropriate documentation and tracking for exceptions during the Reg 9 process. But again, you want to look at trends, you want to look at valuation to make sure that you understand not only what's going on, but what you have to pay attention to, whether you should hold, maintain, or sell or dispose of an asset. One of the most important things during this process is the valuation process. So what I'd like to do now is shift it over to Josh. We can change the slide, and Josh is going to give you some insights on how to make sure you have an appropriate valuation for closely held. Josh?
Thank you, Patrick. So what is the value that we're determining? And at the heart of it, it is fair market value. Fair market value is the most widely recognized and accepted standard of value and is the cornerstone of Revenue Ruling 5960. You know, fair market value is defined as the price at which a property, or in this case, a business, would be sold between an important hypothetical willing buyer and hypothetical willing seller in an open and unrestricted market when neither is under compulsion to buy and they both have reasonable knowledge of the relevant facts. So I emphasized the hypothetical willing buyer and willing seller because that is the primary concept of fair market value, where you are looking at which you can sell a business or an interest in an open market. And it's also important because it applies to all estate tax, gift tax, and most trust valuations that you will encounter. Having a fair market value as a framework, sets common ground between appraisers, trustees, fiduciaries, your auditors, and the courts or the IRS. So once we set the fair market value as the standard, how do we determine that value? So valuing a business or a closely held business, there are three main approaches: the income approach, the market approach, and the asset approach. The income approach essentially looks at the company's cash flows and capitalizes them. And it uses a market-derived discount rate or capitalization rate based on investment risk factors associated with the business or the specific ownership interest. Within the income approach, there are two primary methods, and depending on the historical performance or future performance will determine which method to use. So the first method is a discounted cash flow method. This method projects out the company's future cash flows and discounts them back to present value. So you're looking at multiple periods of cash flows, then discounting them back to present value. The next is a capitalization of earnings method. So this is similar to a DCF, except that it only uses a single period cash flow or earnings. And this is more commonly found in stable companies where they have nominal increases in revenue but maintain the same profitability year over year. That would be a good example of when to use a capitalization of earnings method, is when you have a stable company. The next approach is the market approach. So the market approach also has two primary methods, which derives multiples from: one, the guideline public companies, and two, comparable company transactions. So when looking at this, it is important to identify the industry, determine which companies may be comparable. We'll look for comparable companies, we'll look for comparable private company transactions, and we're looking at the size, the industry, and kind of the business operations of what to use to determine the appropriate multiple to apply to either the company's revenue and EBITDA indications. And I use those two because those are the most commonly used multiples. So a multiple of revenue and a multiple of EBITDA. So EBITDA is the earnings before interest, taxes, and depreciation. It is more commonly known as the operating profit of the company and adding back in depreciation and amortization. Lastly, the third approach is the asset approach. This is a fairly straightforward approach where it adjusts the book value of the assets and liabilities to determine the fair market value of equity of the company. This is more commonly found in, as Patrick earlier mentioned, real estate holding companies. So it first starts with figuring out the value of the real estate, subtracting out any of the debt associated with the real estate to get that equity value. A lot of times it is important to distinguish between a book value, which is the cost of what it was reported on the financial statements, and fair market value. So the main theme of the asset approach is marking up the book value of the assets to fair market value. As you may know, not all companies are the same. So depending on the nature of the company, so whether it's an operating company or an investment holding company, the financial performance and the industry in which it operates in will more than likely determine what approaches are used to value. There are certain companies that will only use one approach, but there's other companies that may use all three approaches. So it is really dependent on the nature of the company. And in valuation, you will You will hear us use the word "it depends" a lot. So a lot of it is dependent on the type of business we are valuing. So once we have a base value set for the company, there are often further adjustments to reflect specific ownership factors, and that brings us to discounts. You know, in valuation, the discounts are often the most questioned, scrutinized part of the valuation. And it all comes down to two main factors: a discount for lack of control and lack of marketability. The discount for lack of control is a percentage or a deduction of the company's total equity value to reflect a minority owner, or I'll just use owner in this instance, their lack of control or management of the company's operations. The second is a discount for lack of marketability, which is similar to a discount for lack of control, except it reflects the absence of an open market in which to sell this and the illiquidity that comes with it. As Patrick previously mentioned, one document we look at the most is the operating agreement and the partnership agreement, or the bylaws. These two documents pretty much explicitly state what the control is, or who controls the company, what rights the minority owners have. There will also be restrictions on transfers, withdrawals, which will affect the marketability of the company as well. When we're looking at these, the operating agreement plays an important factor in determining what discounts are to be applied. Some other discounts that you may see are voting and non-voting discounts. So if you have a trust that owns a non-voting share and a minority interest, there will be a separate discount for the interest lack of being able to vote on the matters concerning the company. Then, since these discounts are heavily scrutinized and questioned, it really comes down to the quality of information that is being provided. Next slide, please. So, valuations are really dependent on the information that is provided. The less information we have, the harder it is to value the company. And as you probably can see, the information that we need for the valuation closely matches what Patrick talked about regarding the information needed for the pre-acceptance review. Core documentation that is needed are financial statements or tax returns, and preferably the last 3 to 5 years. I will say, in my experience, it is pretty hard to value a company without receiving some sort of financial statement or tax return. It's almost near impossible. Also, kind of determining what the ownership is. So that could be a share certificate, a shareholder ledger, a Schedule K1, and that comes down to what the ownership of the subject interest is in relation to the overall ownership in the company, and that will determine what control the owner may have or may not have. We already talked about the partnership agreements or operating agreements. The next would be buy-sell agreements. As previously talked about, this has an impact on the marketability. Depending on how the buy-sell agreement is structured, it may be or may not be fair market value, but that could be a whole webinar by itself, but it's important to get it, and it's something we consider in the valuation. Then depending on the company of what their operations are the investment holding company or an operating company, there may be other supporting information that would be required for the valuation, most notably forecast budgets, future operating projections, also prior appraisals that have been done on the business or internal valuations that the company may prepare. If it's an asset holding company or investment holding company, details for the underlying asset, so that would be real estate appraisals, brokerage statements, financial statements if it holds underlying investment in a separate LLC or LP, those would be needed as well. And also annual review report. So if the manager, general partners prepare an annual review or a shareholder letter, those will be taken into account because typically they will talk about the operations of the company, what's going on with it, what the future plans are. All of that is needed to prepare a quality appraisal. So, when trustees are able to facilitate us with good information, we can produce a more defensible valuation that will not only benefit you, but also your client and fulfill your fiduciary responsibilities to make sure there's no liabilities or consequences with getting these companies valued. So that is a very high level of the valuation portion of it when dealing with closely held businesses held in trust. Patrick will highlight some of the key points of managing these and best practices.
Thanks, Josh. I just want to highlight something too. I can't tell you how many times I get a call from someone and say, "Hey, Patrick, we just had someone die, and there's going to be a 706, and there's a closely held business as an asset." And I'd say, "Okay, well, who's doing the valuation?" "Oh, yeah, we're good there. We have a CPA that's been doing the books for years is going to do the 70 is going to do the valuation, and we're covered." And I'd say, "Well, are they qualified?" As Josh just walked you through, he walked you through the methodologies, the discounts, and the information needed, but you have to be a qualified appraiser too. So Josh is an ASA, which is the highest designation you can get, but there's a lot of valuations that have been discredited due to the fact that there was not a qualified appraiser as defined by the IRS. So I hope you take kind of Josh's notes into consideration, because make sure if you do have a local CPA doing the valuation that they're qualified. If not, there's certainly providers like Josh and others that can help. But I do want to mention that because I see it once in a while. But Josh, thank you for that overview. Great job. Appreciate that. And again, if you're having your fees depending on a fair market value, that valuation is critical. In summary, before we take questions, and again, if you have a question, you can submit it under the question up in the top. This is just a quick summary, but we hope you learned a few things today and specific to closely held businesses. First and foremost, your pre-acceptance process is critical. Making sure you're gathering enough information, the right information to make an informed decision. Consider a checklist to have consistency. Making sure your valuation, that you're aligned with proper experts and they're qualified. Creating additional controls and oversights, as we mentioned. Again, maybe you want to risk rate your assets, as I mentioned today. Evaluate your estate settlement process and align with experts as needed. And last but not least, make sure your policy, procedures, and governance structures are all in place. We wanted to leave time for questions. So at this time, Josh, I think we're done, but we got 10 minutes for questions, and I'll turn it back over to you.
Yeah, so we've had some pre-submitted questions before the webinar. Patrick, I'm sure you could handle most of these. So what is the expectation to obtain valuations and how often? I'll touch from my perspective. It really depends from what we've seen with our clients, what the nature of the company is. So if it's a controlling interest, you may want to do it annually because you're on the hook for being able to control it. So that may be done more frequently than if it's a real estate holding company. Those may be done every year, every 3 years. It's just all dependent on what your comfortability is with the asset, as well as the value of the asset in relation to your overall concentration of the trust account.
And I guess, Josh, from my perspective, the OCC handbook is very specific. It says a periodic valuation. That's the word it uses. I would say industry standard is give or take 3 years. But to your point, if there's higher risk assets, I've seen them done annually, such as an operating company. And I do think it's a best practice, in my opinion, to get a more frequent valuation if things change and or it's a higher risk. That would be how I would answer that question. But I often see 3 years as well.
What is extra due diligence needed on closely held where you would be managing or controlling partner?
So actually, we skipped one there, Josh.
Oh, okay.
I'll
Yes,
take the
I
first
did.
one about the undivided 50%. So if you have an undivided 50% real estate interest, now again, I'm not sure if this is supposed to be held in a closely held or not, but regardless, in my opinion, if that situation happens in an irrevocable trust and you're trustee, and let's just assume that you have sole authority for that asset, in my opinion, you need to get as much documentation as you can get to support things like how is the asset managed, how are expenses paid, very importantly, what are your withdrawal rights, right? How can you get out? Because sometimes that's restrictive. So you have to really watch that. How decisions are made, tax returns. So you want to get as much information as you can. Now, oftentimes those agreements might be the same for 150% and the other 50%. Now, if it's held in a closely held business, you have an extra layer on there that you need additional documentation for. Now, I do want to preface that with some of these questions, I don't want to take up too much time on each question, but if I don't answer your question sufficiently, or Josh, please email us and we certainly can expand on this, but I want to leave time for the other questions. Now I'll answer the next question. What is the extra due diligence needed on closely held where you would be a managing or controlling partner? So assuming that you're a trustee, you're going to be more involved from a controlling perspective. So you need to understand what your responsibilities are. That might be attending board meetings. You might need board representation, right? You need more visibility to financials, more visibility to operations. So again, it would depend on your span of control and management and what that means. But I would recommend reviewing the document, understanding your management or control responsibilities, and aligning yourself to make sure you're gathering enough information that you're comfortable. So all that information I mentioned to understand the decision-making, the operations, and the board perspective.
Yeah, and I think, Patrick, one thing you could also add to is, I think you touched on this, making sure you have the expertise to be a managing or controlling partner. And I think that would be dependent on the operations of the company. If you have a hardware manufacturing company but have no industry experience in it, it may be difficult to kind of be the manager or controlling member of that company. So that may be some other due diligence to be checked on.
Well, the other thing too, Josh, is it depends on their policy and procedures. Some organizations do not allow an employee to sit on a board, so they may have to hire someone, to your point, that is an expert in that area. So you're 100% right.
What are some tips on exiting or winding down closely held entities when they are no longer needed?
So the first thing I would always recommend with either wind down, exiting, or distribution is making sure things are in accordance to the contracts. So earlier we mentioned making sure you understand your trust agreement, making sure you understand any operating agreement bylaws, and making sure you're in accordance to the proper approval levels and or sign-offs that are needed. So that's the first thing I would, from a tip perspective, make sure you understand the process. After that, make sure you understand the valuation process. If it's a sale or a distribution, how that's going to work. And last but not least, another tip is make sure as trustee you're held harmless. So send them a letter, hold yourself harmless, and make sure that everyone's on board with how the process went down in accordance to the agreements and that everyone's on board. You have a waiver or hold harmless. Those are a few tips there, Josh.
Yeah, and I think one thing I can add is the value aspect of it, to make sure if you are winding down, depending on how you're exiting, are you liquidating the assets? Are you selling the ownership interest or the business outright? To make sure that value is a fair value, to avoid kind of what we talked about earlier of any conflict of interest with the beneficiaries, and make sure you're doing right by them and kind of remaining the fiduciary expertise that you are providing.
Agree.
Last question is, it's kind of a statement, would be interested in any requirement, valuation, frequency, red flags, mitigating risk, and document suggestions. I think pretty much a lot of that you touched on, and comes down to the pre-acceptance review and determining figuring out what your company procedures are and how you want to proceed with accepting a closely held business.
Agree. Pre-acceptance is the key. We talked about valuation frequency. Red flags would be fluctuations in price, right? Something declined from a perspective that was unreasonable, or income we talked about. Mitigating risk, we talked about risk rating your assets. We talked about a strong pre-acceptance process, reviewing the financials. So those would be some documentation suggestions, Josh, but agree. And again, if there's more extensive answers needed on this, certainly people can reach out to me. So.
And I think that's all the questions we have been asked so far. And if there's no other questions, we really appreciate you guys joining us today, and hope you gain some valuable insight on the fiduciary responsibilities for closely held businesses.
Thank you for having me. Great to see everybody. Thank you for your time.